The information provided in this program is of a general nature and is not intended to be personalized financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. The Fed has stress tested America's biggest banks under a worst case scenario. They passed, but should we trust it?
The exam is extraordinarily rigorous, and they are very good results.
And 10 million Australians are investing, 1 million more than in 2020. So who are the newcomers and what are they buying?
They're more likely to adopt ETFs now than at any other stage in history.
It's Friday the 30th of June and you're watching Markets with Madison. The Fed has stress tested 23 of its biggest banks in a severe recession scenario, where they'd lose a collective $541 billion US. It included a near 40% decline in residential and commercial property prices and unemployment hitting 10%. The Fed says in this hypothetical situation, all the banks would survive and remain above their minimum capital requirements. Well, Gerard Cassidy is a US banking expert and a friend of the show. Hey Gerard, good to see you.
Good to see you. How are you, Madison?
I'm very well. How are you in the States?
It's great. It's summertime, so we're happy.
Lucky for some, it's absolutely freezing here. Let's talk about these stress tests. I'm a little bit dubious about them because last year the Fed said that our banks were resilient too, and some of them proved not to be. So are these results worth the paper they're written on, Gerard?
Madison, it's a really good question to question the quality of the exam, but the exam is extraordinarily rigorous, and they are very good results, and they should be looked at and supported by investors and other regulatory officials. The failures of Silicon Valley, First Republic, and Signature banks were really quite idiosyncratic, and they did not represent the mainstream American banks. And as a result, when you look at these stress test results, they really stress the banking system for severe credit losses. And what happened with those banks that went out of business in March had nothing to do with credit. It was all due to a duration mismatch between their bond portfolio and their funding sources. And unfortunately, those banks, again, were very different than the mainstream American banks. And therefore, our mainstream American banks do not fund themselves the way those banks did. And when it led to a run on the bank, it caused those banks to go out of business. But the stress test results that were released yesterday here in the States were very rigorous, and the banks all did very well.
Now, those 23 banks that were assessed this time, they're effectively the ones that are too big to fail, right? Silicon Valley Bank and other banks that are smaller and more regional wouldn't have actually met the threshold to be assessed under this test. So do you think they would have passed this, as you say, rigorous assessment?
Absolutely. They would have passed it with flying colors. And again, the criticism of the test post Silicon Valley is that it doesn't test for the triggers that put those banks out of business. Now, next year's stress test, there's a discussion on changing some of the metrics they're going to use to stress test the banks to focus on this duration mismatch issue. But these three banks, if they would have went through the stress test this year, they all would have passed.
Isn't that an issue then? I mean, does that not then make us need to question the viability of this test?
No, good question. And once again, when you look at the mix of funding for these three banks, so let me give you an example. These banks did not use consumer deposits to fund their businesses. They used deposits that were greater than $250,000. And what that means here in the States is that those deposits are not insured. And as a result of them not being insured, should there be any sort of cracks in the armor, if you will, those deposits could leave the bank. And so in the case of Silicon Valley, less than 5% of their deposits were so-called consumer deposits. 95% were wholesale deposits or large deposits. On a typical American bank, 45 to 55% of their deposits are consumer, which means they're insured and they're very sticky. And so as a result, This test was driven by the results of what happened in 08, 09 with the financial crisis, and it measures for credit quality. And again, the test was very rigorous. It measured credit quality very well, and the banks came out in flying colors. The problems with the three banks that failed had nothing to do with credit quality, completely different. And they're going to create a supplement test, if you will, to make sure that banks don't run into the problems that Silicon Valley had in next year's test. But I guess what I'm trying to emphasize is how idiosyncratic those three banks were. That is not a representative sample of American banking. They were so different. Here's another tidbit for you. We have discovered post-Silicon Valley failing, we believe 11 individuals that were part of the venture capital community, because that's the community that bank banked. 11 individuals controlled 40% of the deposits at Silicon Valley. That is shocking. No bank in America has that kind of concentration risk. And so the reason those three banks would have passed this test is that they didn't have credit problems. What they had was a funding problem and a concentration problem, which this test does not test for. But when you say, well, what about the other banks? What if they have that concentration risk? No one has that concentration. It was idiosyncratic to that bank.
Now, this test did actually put these 23 banks through a bit of a market shock situation, considering interest rate rises. How did they shape up coming out of that test?
Madison, I'm glad you brought that up, because there was what they called, I think, the exploratory, is a new test for the very largest banks, the investment banks, and they actually came out better in this exploratory test that assumed there was going to be higher interest rates and higher inflation. And as a result of that exploratory test, which was not used in determining capital ratios, the banks came out better. They came out stronger. So it's the regulators, I think, are going to go back to the drawing board and come up with a tweak to the test next year that will test for concentration of deposits over $250,000, and then also unrealized bond losses and the impact that they have on capital.
Make no mistake, though, this pretty severe test did put pressure on these banks' capital adequacy ratios. The Fed says that they were in aggregate with this pressure sitting at around 10%, but some came in lower than that.
We believe so. We have to remember banks are in the business to make money and drive shareholder value. And you can certainly pile on excess levels of capital that is really not needed. But if it makes the regulators happier or people feel it's safer, they certainly can do that. But they're not maximizing or optimizing the balance sheet. So though what you saw are some of the banks' CET1 ratios were below 10%, they're still all above the regulatory requirement. I think the lowest one was Citigroup, which was 70 basis points above its regulatory requirement, but other banks were 200 to 300 basis points above the requirement. And so the measure is you have to be at the requirement. So somebody who's 500 or 600 basis points above the requirement is actually, in my view, not doing the right thing for its shareholders because it's too high. But on the other hand, you don't want to be too low. I would agree that having only 50 basis points above the requirement might be too low. So the perfect spot might be 100 or 200 basis points above what you're required to carry by the regulators. And that gives you a cushion should there be some greater problems that actually show up in a real downturn.
Now, I don't mean to sound like such a cynic, but I kind of just am by nature, Gerard, especially when it comes to US banks with what we've seen this year. How convenient is it for the Fed for all 23 big banks to pass?
Once again, we're comparing apples to oranges when you think about what happened in March to what this test was about. So you almost have to disregard the events in March when you look at this test. And the test did not test for what caused those banks to fail in March. So when you look at it for what it was designed to do, which is to measure the deterioration of capital in a severe recession due to credit problems, then it's a very valid test, a very rigorous test, and the banks came out very strong because over the last 10 to 12 years, the banks have been building up capital. So I think you touched on it in your comment a moment ago that the group, the CET1, the Common Equity Tier 1 ratio, was just over 10% for the group. Well, in the 2010 test, that number was 4%. So from 2010 to today, the group has built up its capital. Now, we need another set of tests, if you will, to measure what happened in March to those three banks. And I would suggest to you, there will be that test next year, no doubt. And I will suggest to you today, they're all going to pass.
What do you expect these results to do for investor and even consumer confidence in banks? Because the Fed is very clearly trying to maintain confidence in the US banking system this year.
Sure. No, you're right. This is certainly a confidence booster to have the headlines come out that all the banks have passed the test. The stock prices are reacting favorably to it. But most, in all candor, in all frankness, most consumers don't have over $250,000 in their checking account or their deposit account. And I don't think the average consumer on the street, if you ask them about their bank, if they're worried about the bank failing, because to most Americans, that's not an issue. Now, to high net worth individuals that have multiple millions, or to small business operators, yes, then that's, I think, much more important to them than it is to the average consumer. But we have to remember, we receive and analyze the weekly deposit data that comes out from the Federal Reserve. And the deposits, as you might imagine, in the March Madness, when this all went down around the 9th of March, the deposits for the smaller banks declined and they went into the large banks. But that's reversed itself. And what we've seen in the last 7 weeks is small bank deposits have been flat to up. So all of the deposit flight, the fear on deposits, that's all behind us. And again, I have to emphasize, it was idiosyncratic to three banks. This is not going to be repeated, in my opinion.
Did you know that New Zealand doesn't have a deposit insurance scheme? How crazy is that?
No, that's very crazy. That's like what the Americans had before the 1930s. And it forces the banks then to be, in New Zealand, to be very conservative because they don't want their depositors leaving. And if they make any mistakes, that money can leave very quickly.
1930s, but just a little bit behind. Hey, thanks so much for your time, Gerard. Always great to chat.
Well, thank you for having me. I appreciate it, Madison. Have a good day.
Staying with the Fed, Jerome Powell spoke at a conference in Portugal this week and said while it may hike rates more this year, he doesn't expect the US to enter a recession.
It's so uncertain right now. In my view, the least unlikely case is that we do find our way to better balance without a really severe downturn. I think there's a significant probability that there will be a downturn as well, though, but it's not to me the most likely case.
Closer to home, a new study shows half of Australia's adult population, 10 million people, are investing outside of their super and family home. That's 1 million more people investing in 2 years, a period which included one positive and one negative year for its benchmark index. Now, a lot of the newcomers are younger and they're female, and their investing styles are a little bit different. Rory Cunningham is from the Australian Securities Exchange. Hey Rory, I am so jealous of this result. Surely you're pretty thrilled with it too?
Yeah, it's really interesting. I mean, this is a piece of research that we've been doing since the late 1980s, and it's really, really important research, but definitely the growth in new investors over the last couple of years has been really pleasing to see.
What do you put that growth down to?
I think a few observations about why new investors entered the market. I think it's fair to say that in Australia, but also around the world, COVID-related lockdowns were a catalyst for investors or non-investors around the world, and particularly in Australia, for doing research about how they should be investing their savings. So we definitely saw that in the market. There was a step change, and that has continued on in terms of the trading activity in the market post-COVID, and I think that's reflected in the number of new investors as well. The other thing is around the number of new trading platforms. It's effectively the barrier to entry these days to invest is a mobile phone, right? And new technology players keep coming out in the market and offering new and interesting ways to get investors into the market and encourage them to invest for their future.
The newcomers, they like ETFs and crypto, and women particularly say that they prefer stable returns, not volatile returns. What challenges does that pose for not just the ASX, but the entire investment ecosystem?
It is a strange one when you see that younger investors and new investors prefer stable or guaranteed returns, but one of the top products that they use are cryptocurrencies. It's kind of counterintuitive there, isn't it? But I think we need to take the stats on crypto, first of all, a little bit with a grain of salt. I mean, the research shows that it's still a pretty immaterial amount that investors are investing in crypto. You could almost say that they're dabbling in crypto to understand how that product works. The more, I think, interesting observation and stat coming through is the adoption of ETFs, both amongst new investors. They're more likely to adopt ETFs now than at any other stage in history, but also amongst the general investing population. And we saw a huge growth in terms of ETF adoption. When we last did the survey in 2020, 15% of investors held exchange traded funds, and that has grown to 20% now in Australia. So it's the fastest growing product segment, and that means there's about 2 million investors that are holding exchange traded funds in Australia.
Does that change the way the ASX thinks about the number of ETFs listed on the exchange? Are you now more likely to list more of them? And how critical is it now that your big listed names have to be included in these ETFs?
Yeah, so I suppose we've always tried to encourage new entrants into the ETF space, be they domestic managers or also global managers. But of course, we're a marketplace, so you need the investor interest on the other side. So we're definitely getting to a scale and size now in Australia that global players as well as domestic players see ETFs as an attractive vehicle to be able to access investors. So what we're seeing then from our perspective, a broader range of products across all asset classes that are being made available to investors, which I think for investors is a positive, right? We want investors, our mantra is for investors to be able to build diversified portfolios across all asset classes, and from our perspective, that's really important.
What do you think is peak percentage of investment in ETFs?
I won't be drawn into answering that because I'll be wrong, but there's still a lot of headroom. I think if you look at ETF market share versus other equivalent products, so say managed funds, or ETF adoption versus the total investable assets in Australia, it's still really low. So despite the positive growth, there's 130 billion Australian dollars now invested in ETFs. We have almost 300 ETFs listed on the exchange. That sounds like big numbers, but relative to the overall savings and investable assets in Australia, it's still relatively small. And when we compare that to other regions around the world, our penetration rate still isn't as great as markets, say as the USA or even Canada and some markets in Europe. So still plenty of room for growth.
The newcomers are also getting their info from different places, right? Instead of going to advisors historically, they're watching things like YouTube videos. I'm clearly pretty pleased by that, but how do you and the exchange feel about it?
Well, I think it's good. I mean, at the end of the day, investors will consume information and get knowledge from the most convenient place possible. What's really important for us, and we do a lot of work around this when we're thinking about how we produce investment education, is the quality. We want to make sure that we're being unbiased. We want to make sure that we're delivering holistic information to investors. We want to make sure that we're not treading into the area of financial advice. And I know our regulator has been quite focused in that area over the last couple of years as well, which I think is a positive for investors, because we should all be trying to ensure that they get, I suppose, information from qualified people in the market.
Couldn't agree with you more. What's your advice to investors on your exchange?
What we're always preaching to investors is to ensure that you have a diversified portfolio. So you shouldn't just be looking at Australian shares. That might sound counterintuitive coming from the exchange, but we really are trying to encourage investors to have a diversified portfolio. So that means investing a percentage of your assets in Australian shares, and that's fine. But you also need access to international shares, be that directly or through a wrapper such as an exchange-traded fund or a managed fund. You should have access to property, although most investors do tend to hold property directly, but there are other vehicles such as real estate investment trusts, be they listed on ASX or overseas. And then lastly, bonds. Bonds are back. One of the big investment themes that comes through a lot of our research and in our seminars, in educational seminars that we hold with investors, is that people are after income now. And so there's a lot of education that we have to do with investors to explain how bonds work, because we haven't been investing in bonds for the last 5 years. So I think it's the idea is have a diversified portfolio across all asset classes, not just Australian shares.
Well, I never thought I'd see the day where a stock exchange recommends buying something other than equities. Thanks so much for your time, Rory. Good to chat.
Thanks, Madison.
Now we're going to end the show on a little public service announcement. Tiger Brokers, which runs the online trading platform Tiger Trade in New Zealand, has been done for breaching anti-money laundering rules, relating to about 60 million New Zealand dollars worth of transactions. It's been ordered to pay $900,000 by the FMA. If you haven't been fined though, go and put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.